Hey, Adrian, do you think that whole life insurance is a scam?
Yeah.
Okay, well, you want to find out for sure?
Yeah.
Okay, let's figure it out.
Whole life insurance is probably the most controversial topic in our 70,000 member Facebook group. Like, if anybody ever brings up whole life insurance or any kind of insurance other than like SGLI or term policies, people freak out. And I'm not even kidding. It seems like they're at each other's throats in the comments. And the reason is just because a lot of people have gotten screwed over. All right. And so I'm going to go over in this video really pretty quickly and concisely because I've had to learn about this topic myself in depth, and then I've had to watch our members experience both and hear their stories, and then I've purchased both myself. You know, I've had SGLI outside of military term policies and a whole life policy. I've been there, done that. We actually started a brokerage for this just to be able to serve our members the right way, and because of that, I want to just break all this down because every single time somebody pops up a comment, we inevitably have people hating on the comment about whole life insurance. Some people just loving it and just swearing by it. And then agents coming in who are not associated with us trying to solicit business, which ADPI is just quite honestly absolutely against, because there's no way we can serve our members when there's agents outside of our brokerage that are trying to serve you, because the spectrum of what they can offer is from awesome to absolutely terrible, like basically almost theft. And so we don't want that. We want to protect our brand. We want to protect our members. So without further ado, I'm going to kick off this conversation, and I'll cover basically term insurance, SGLI versus VGLI, the difference between term and permanent, and then I'm going to go into whole life insurance, who this is for, who this is absolutely not for, explain why it's not an investment, but then I'll explain how to use it as a tool for investment, and we'll just go through all of that. And then if you guys have any questions, absolutely drop them below. And if you're new to our channel, my name is Mark-Jan Sitch. I'm the founder and CEO of Active Duty Passive Income, which is a military real estate investing education community. And we're all about being entrepreneurial, doing financial cool tricks outside of the norm, and investing in real estate so we can create more income during, after the military, and then have an amazing legacy for our families for generations to come. All right, here we go. So first things first, term insurance. Well, actually, let me just make the comparison. Term versus permanent. Okay, term means it's going to be for a specific term. It's temporary. Permanent means it's for your whole life. And a lot of people sometimes when they think about that, they're like, oh yeah, I want it for my whole life because I don't want it to end at a certain point, because then after that, what if I pass away then? My death benefit will be non-existent, right? It stops at a certain point. And when you think of life insurance, typically people think of what? They think of, oh, this is for a death benefit. If I pass away, hundreds of thousands of dollars will end up being just a check written to my family, right? So that it's basically supposed to substitute for a while at least the income you were bringing in to your family, right? So this is supposed to help kind of buffer that shock if you pass away, right? So, because I mean, first of all, it's not only your paycheck. You also have to think about quite honestly, dying is expensive. You need to, whether it's cremation or you want a burial, all this kind of stuff, that stuff costs a lot of money. And if you pass away, that burden being on your family is really, difficult. So now that we know the difference between term and permanent insurance, term is just temporary, typically 10, 20, 30 years, and then permanent is for your entire life. Permanent, for that reason, is typically more expensive because once you lock in a policy, you lock in a price that's going to carry you out till you pass away. So, but there's different flavors of permanent insurance, and we're going to get into whole life, which is one of them here in a little bit. There's also universal, but I'm not going to get into that now. That one's a little bit more technical and honestly not as good as whole life if that's the route you want to go. Let's talk about SGLI and VGLI just a little bit. Just super broad brushstrokes. SGLI is what you have while you're in the military. VGLI is when you transition out of the military. SGLI is super, super cheap. You can get, I think it's about 6 cents for every $1,000 of death benefit. So your monthly premium is about 6 cents for every $1,000. It's actually pretty cheap. I think when I was in, it was about $24. And I think that they just increased the cap from $400,000 to $500,000, but don't quote me on that. I'm just doing this off the top of my head for how much you can have in death benefit for yourself or for your family in case you pass away. And the cool thing about SGLI is that obviously like they understand that you're in the military and you're in a very risky business, which sometimes if you try to apply for term insurance outside of SGLI, they will scrutinize like what your military job is, and your premiums might be higher because you are a riskier individual, whereas SGLI kind of protects that. While you're in the military, while you're in the service, it allows you to have that, standard rate that's very inexpensive. Sorry about the beeps on my computer. So let's talk about VGLI. So when you get out of the military, you can convert it to VGLI, but VGLI, the pricing depends on your age. And as you get older, it goes up and up and up and up. And so the same premium, I think, for a 60-year-old would be $200-300, right, a month. So it really starts going up fast. And they might start looking into other things and to determine your pricing. So your age becomes a factor. It's not locked in. So early on, when I was still a second lieutenant or first lieutenant maybe, I realized, wait a second, I don't think I'm going to be making the military like a career, right? And I also want something before I turn 30, I think it was about 28, to be locked in for 30 years, okay? So I decided I wanted to have a term life policy for 30 years, because here's what I was thinking. I was really big on finances. I was like, by the time I'm 58, right, I was 28 at the time, I better have my life figured out to where I don't need a death benefit for my family. But I do want a very inexpensive term life policy that will be the same. I think it's like $28 a month. That gives me $600,000 in death benefit for my spouse and my children in case I pass away. And I have that $28 price locked in for 30 years. And you know what? So I was like, I canceled my SGLI. I got this. I got a term life policy. And that was it. It was that easy. When it comes to death benefits, term policies are the best, right? Because you're just looking for, if I pass away, I get money. The end, right? It doesn't have it's nothing to do with anything else. Like no other kind of riders or anything like that. If you're just looking at it black and white, hey, I want a death benefit, boom, get a term policy. And get it as soon as you can, even when you're in the military. And honestly, I think it's better than SGLI. If you never plan on doing permanent life insurance, I do think that if you're seeing that, hey, on the horizon, I'm probably going to be getting out of the military, I'd recommend start thinking about that before you're 30, if that's the case. And I'd recommend locking in a 30-year policy. And, that's that. It's just so much. It's the cheapest death benefit you can buy. And if you buy it early on and you get a full 30 years, it'll probably last you for the amount of time you actually really need it. Okay, so let's talk about permanent life insurance. Specifically, let's talk about whole life, right? There's different kinds of permanent life insurance. Let's talk about whole life. Whole life is expensive. Whole life is not for everybody. But that's because whole life isn't just about the death benefit. Whole life is about something completely different. Think of whole life as a glorified savings account. It's like a savings account on steroids, in fact. But here's where things get hairy. A lot of agents and a lot of life insurance companies don't do them the right way. So what we like to focus on at ADPI, because we have adpiinsurance.com, we started a brokerage because I wanted one of these. I was like, I want to be a real estate investor. I want to have a high yield savings account, essentially, that if I borrow against that, I can use that money for my real estate investments and whatever other life needs while that money continues growing. That's the magical aspect of this thing. Like with a regular savings account, you put money in, you can't borrow against it. You have to take your savings out and use them. When you do that, the money disappears from there. Or like that amount you took is no longer in your account there. So it's no longer growing at that high yield. So I wanted this policy. I wanted a whole life policy, but I was so worried that it was going to be structured in the wrong way to where the agent's going to benefit the most because they're going to get this super high commission. And I was like, no, I need to figure this out. But everybody was claiming that they were the best at this. And it was like there's all these, clouds and mirrors, smoke and mirrors, right? I'm terrible at idioms. And I was sick of it. I was like, I want to figure out what's going on here. And I quickly figured out that this is definitely not for everybody. Like if you're still living paycheck to paycheck, not for you. If you have a large, healthy reserves and savings account, and you have a plan for investing that into cash flowing assets, whether it's real estate or not, then this could be a great tool to accelerate how you grow your portfolio of assets that cash flow, right? It's something that you can start making that your savings account and borrow against it fluidly back and forth, kind of like a home equity line of credit, kind of like a reverse credit card, whatever you want to call it. And it's going to continue growing in value over time, and even when you're borrowing against it, right? Because you're not using the money in the account, you're using the life insurance company's money. You're just borrowing against that policy. Basically, the cash value you have in there is like the collateral. It's what they're going to take away from you if you never pay them this back, right? That's all it is. So it's actually super simple. It sounds complicated, but it's really not that complicated. And the nice thing is you can actually, the cost of borrowing that money is cheaper than the rate at which it's growing. So you're actually making money even when you're borrowing against the policy. It's still growing even while you're borrowing against it. So enough on that. I don't want anybody to think that I'm like pushing whole life policy right now, because there's a lot of sleazy ways of pushing this and kind of hiding the reality of how good it actually or bad it actually is. And they can be definitely structured in such a way to where years down the road, you still have almost no cash value in your policy, in like this savings account we're talking about, that you can really speak of. Like you could be investing like, I don't know, $50,000, like maybe paying $5,000, $10,000 premiums every single year, and then find out after 5-10 years, oh wow, I only have like $5,000 of cash value in there. Well, it's because it was probably structured in such a way to be mostly skewed towards death benefit, which again, I mentioned this earlier, death benefits are best in term policies, right? You want this to not be treated, not be focused on the death benefit, because there's like tons of little levers you can pull when you structure these, and you can make them focus or benefit certain things. And I always try to like minimize the death benefit. I'm not going to get too technical here, but you need to make sure you know what you're doing, because you need to make sure it doesn't become a modified endowment contract, in which case it stops being anyways. Point is, you need to have somebody that knows what they're doing when they're structuring this. So they pull all the levers, and we make it as aggressive as possible to be as much of a savings account as possible. And so you're just putting your money in there, and after year 4 or 5, after basically the cost of structuring the policy and all that is accounted for, you will probably be breaking even. So if, let's say, you do $10,000 a year, after about 5 years, you have $50,000 in it. Probably all of that will be cash value that you can borrow against, right? So if you don't need that money immediately, and you're okay with like initially there being a haircut on it, but by the time 5 years are up, it'll basically everything you put into it will be available as cash values. It'll initially start off at like maybe 85% of what you put in is available, and then it grows to 90, 95. It slowly over 5 years it gets to the point where everything you put into it is available as cash value, and then after that it just grows beyond that. You'll have more cash value in it than the cash you actually put into it. So it's actually growing kind of like an investment, but we do not think of it or treat it like an investment at all. This is just a tool. Because if you want to invest money, right, there's way better returns on investment elsewhere. But this is like our main agent, Derek Morrell, calls it like a fortress. This is something that cannot go down in value. This is not like the stock market. It will never go down in value. In fact, it's going to continue growing at a minimum rate of, I believe, like 4.5%, plus potentially another % or 2 every single year. Like, it's never going to go in the negatives. It hasn't since the inception of these mutual companies, because they invest in the most stable assets in the country, right? They invest in like skyscrapers and stuff. Like if you go to New York and you see like all these life insurance companies on the top of the big buildings, that's them. They invest in long-term and the most stable assets in America, right? And they've been around for well over 100 years, and they have never skipped a dividend payment, which goes towards your cash value. But I'm not getting into that. Sorry, I get really excited. So here's the reasons why you might want a whole life policy. If you have plenty of resources or like reserves in a savings account, if you are looking for a high yield savings account, essentially, right? But you want to be able to still use your money while it's still growing. You want to borrow against it, right? Because you know that you want that money fluid, so you can do things with it, like maybe do renovations on a home and then refinance, put the money back, that kind of thing. You want to operate dynamically out of that account. You want to be a very nimble real estate investor. And you know that it's not an investment. If that fits you, and you know that this is not, I mean, it's going to have a death benefit. I think mine has like $1 million or $1.5 million death benefit, but it was not structured for the death benefit at all. If that describes you, then this might be for you, right? If you are living paycheck to paycheck, then this is not for you. If you don't have an investment strategy for this, this is not for you. So yeah, that is basically this. Let me just make sure I'm not missing anything. I wrote down some notes. That's the nuts and bolts of whole life insurance. That's the difference between term and permanent, and how I explained how SGLI and VGLI works. So if you're in the military and you want more death benefit, you should get a pretty inexpensive term policy and try to get it before you're at least 30 and try to lock it in for 30 years. That's the best way. If you're looking for a high yield savings account to help you invest faster, to create more cash flow faster, then it might be good to look into whole life insurance, in which case ADPI does this. So if you go to ADPIinsurance.com, there's a small video you can watch about it that similar to this one where I explain it. There's also a training which will go through everything. And then there's actually, there's a form that'll pop up most likely that'll ask you to fill out all your information, and then you can set up a call to discuss structuring a policy for yourself. If you want to go directly to just structuring the policy, if you feel like you figured it out from this video, go to activedutypassiveincome.com/CFA, Charlie Foxtrot Alpha, which stands for Cash Flow Accelerator. That's what we call these, because they truly, if you continue leveraging against them to buy more cash flowing assets that then pay it back off and you kind of rinse and repeat, you cause that cycle, it accelerates how fast you can grow your portfolio of cash flowing assets. So your cash flow grows faster. All right. Well, that's about it. Mark Jancic is out. Talk to you guys later. See ya.